Hey out there, welcome into another edition of Market Takes. I know you could have been anywhere in the world, but you're here with me. I want to say thank you for that. I'm your host, Dion Rabouin, reporter at the Wall Street Journal. Before we jump into today's CPI inflation report, I just want to make a real quick announcement. We are supporting our colleague, Evan Gershkovich. He has been detained in Russia. The hashtag is I Stand With Evan. If you don't know, now you know. Please, if you haven't, look into that, check that out, do some research. We're spreading the word, trying to get awareness out about our colleague who has been detained in Russia. So wanted to make sure I spoke to that this morning because that is a lot bigger than a lot of what we're doing. But of course, I know you're here for the data, so we are gonna dig into that. Listen, we are talking about everything from this morning's Consumer Price Index report. It is moving the markets this morning, and I think could potentially move the markets going forward. I'm going to tell you just why that is. So we're going to talk about what we saw in that report, of course, the expectations coming in, how today's report really aligned with, and some of the differences and some of the interesting wrinkles within the report today. We're going to talk about, of course, the market reaction. We've got a new tool. We're going to be able to show you how markets are reacting almost in real time. We've got about a 15-minute delay on that, but you'll be able to see the reaction from this report that came out this morning at 8:30 to right about now as we're dropping market takes here at 10 a.m. Eastern time. Of course, we're going to talk about the current environment surrounding these reports because, of course, we know that this report, CPI, and others don't just come out in a vacuum. And then, of course, we'll be talking through what comes next. So we're going to get into all that. First off, the CPI report this morning showed headline CPI or overall CPI rising at a 5% rate. So what you're seeing there on your screen is the year-over-year change in the CPI. Now, you see starting in April of 2022, it picks up there. That was when we were seeing that 40-year high inflation. In June, the third bar there on your screen, that's 9.1% inflation, the highest we had seen since the early 1980s. And then you see that just consistent move lower over those following months. Now, what's really interesting about today's report is the actual month-over-month inflation only picked up 0.1%, and that was actually 0.05% increase. So really close to no inflation increase overall in the month. That compared to expectations for it to fall to 5.1% year over year, and that was down from the previous month when it was 6%. You see there in February, and then 6.4% you see there in January. So a kind of precipitous continual decline and decrease in the year-over-year pace of inflation according to the CPI. Now, I want to contrast that with what we've seen from core CPI, and that's an important indicator because it strips out volatile food and energy prices to give you more of a look at what the Fed can control and one of the things that the Federal Reserve watches in terms of when they're looking at the market. So I want to put up here the CPI core chart, and as you see, the numbers don't go up as high. It remains around 6%, but then we still have seen since late last year, since about mid-year in 2022, those numbers kind of consistently coming down until you see that last bar there. CPI core picked up by 5.6% last month. That was the first increase we'd actually seen in the CPI core since September, and actually CPI core was 0.4% month over month. So again, a bit of a worrisome trend here where you see consistently inflation had been falling, declining overall, and that continued, but core prices, stripping out again food and energy prices, which move significantly, taking those out, you see it picked up. So again, just wanted to illustrate what we've seen long term and the differences between that CPI core report and the overall CPI report. CPI is doing what the Fed wants it to do, just come down, decrease till it gets to that 2% target. Core CPI, though, this month bucking that trend a little bit, and that's interesting. Now, why do we talk about core CPI? Why does it matter? Well, because it strips out those volatile pieces and things that the Fed really can't control. The Fed doesn't have a lot of control over oil prices. The Federal Reserve doesn't really have a lot of control about food prices. A lot of that's based on commodities, how they're trading on the open markets. What the Fed can control by raising interest rates is controlling how people are hiring, whether they're giving raises, things like that. Because when markets get tight, businesses can't borrow. They can't afford to, increase the size of their business as much. Consumers can't afford to, really take out those loans against their homes, things like that. And so it slows down the economy. And when core prices rise, as they did in March, you start to see that be a little worrisome for the Fed. And that's why, the Fed thinks of core CPI as a better predictor for the future pace of inflation. And even though we have seen overall generally the CPI come down, we did see that core pick up this month. So that's why there might be a little bit of consternation in the markets this morning. Getting into the weeds just a little bit, I want to get into here because I know that's what y'all like. You like when we get a little nerdy and we talk about the details. The shelter prices were lower than they've been in about 6 or 7 months. You had a 0.6% increase month over month, down from 0.8% in February. All that means is, and here's why that's big, I want to read you a quote directly from the BLS's CPI report this morning. Quote, "The shelter index was the dominant factor in the monthly increase in the index for all items less food and energy." Basically what that means is that core index that you saw pick up, the biggest piece of that was shelter. Now, why does that matter? Because our real-time data has shown us that increases in rent are declining, that the pace of rent inflation and overall housing price inflation has slowed down. The Fed has seen this, they've talked about it. They've said, we know those are coming down. That is a lagging indicator in the CPI report, and the Fed and other economists have talked about, well, CPI is most of the thing that's holding inflation up, and it's most of the thing that's holding core prices up. That's going to go away as the new data starts to get factored in. We don't know when that'll happen because BLS does not have an exact methodology for when they include changes in shelter prices. We know most people sign a new lease in January and then they stay where they are, and that's how it happens, but it doesn't get factored into the data immediately. And so that's a piece that as soon as that shelter piece stops rising as fast, and that's what it appears that we're seeing, once that starts happening, inflation overall could start to drop pretty dramatically and pretty significantly. That would turn the Fed from this very aggressive stance that it's taken to maybe more of a hands-off stance on the market. And that's a good thing for the overall pace of the economy. On the other side, we've always got it on the one hand, on the other hand. Now, one big part of the decline that we've seen in overall, saw the energy component or the energy index fall by 3.5% overall. And you saw the gasoline index down 4.6% from the previous month. That's just month over month after rising for the prior 2 months. Overall, year over year, gasoline was down 17.2%. Well, we contrast that with what we've seen from oil prices. And want to put something up here on your screen really quickly to show you. Boom. You see, overall now in 2022, you see as inflation was rising, as CPI was rising, you see those gas prices rising, right? And then the same theme that you saw with CPI going down, down, down consistently, you're seeing oil prices there on your screen. As we get into 2023, now, as you get to where we are right now, in April, you're seeing oil prices start to pick back up. Now, that could mean that you start to see some of these indexes within CPI pick back up as oil prices go back up. That also has a big impact on consumer sentiment and how folks feel about inflation, their inflation expectations. So that chart is really illustrating the overall trend, how oil and inflation have really moved in lockstep, and we are starting to see oil prices start to pick back up again. We're also seeing this at the pump. Just when you go to fill up your gas tank, we have seen the average price for a gallon of gas rise to $3.62 a gallon, up from about $3.32 in December. So we're seeing a consistent pickup in gas prices. Out in California, we're seeing about $5 a gallon almost on gas prices. This is a sort of worrisome trend that's working in the opposite of what the Fed wants. And we saw that gas price cut, or that oil output cut, announced by OPEC, the Organization of the Petroleum Exporting Countries. They announced they're cutting supply. We know when supply declines, demand stays the same, prices go up. So keep your eye on that. Oil prices are going to be important to watch. Want to put something new up here on your screen here, and that's going to show you what's happening live in the markets right now. So as we look out here on WSJ.com, you see the Dow, the NASDAQ, the S&P all rising higher, but each one, especially the NASDAQ, coming down, and you're seeing prices start to kind of pick back up. But this is a bit of the tug of war that you're seeing in the markets. Want to throw up here really quickly, show you what's happening with bonds. You see the 10-year note, it's down in yield by about 3.3%, or 3.3 basis points, excuse me, to about 3.4%. The biggest move that we saw in the market after the release of this report was in the 3-year and the 2-year. You see in the 2-year, is kind of come back from that big decline that it took after the report. But market's basically telling you with this that they see the Fed having to do less rate hikes, maybe doing some rate cuts. We've seen that in the Fed funds futures market. The market really saying this report indicates the Fed can pump the brakes on pumping the brakes, stop cutting rates or stop raising rates as much, and the market is even pricing in some rate cuts through the end of this year. The market expects the Fed to raise rates once in May and then cut them 3 times after that. Very interesting from the market. Really quickly, want to show you what we're seeing from crude oil. Now, this is also important because when we see Brent crude and when we see WTI crude, boom, you're seeing a big pickup there. You can see this just right after the report is released, jump higher in oil prices. That's because they're expecting more growth, the Fed to have to do less, and you're seeing that response almost immediately from oil prices. So this really, the market's illustrating what we're seeing in terms of the market reaction and how investors are reading this CPI report that we got out this morning. Very interesting what we're seeing there. Let's talk about right now, step back for a quick second and talk about the current environment, what we've seen coming into this report. There has been a lot less talk about inflation. Folks are just kind of assuming, hey, inflation's going to come down, it's going to keep doing what it's been doing. This report offered some evidence that that is happening. Inflation is clearly coming down. The Fed's processes are working, but there are still some things to keep your eyes on, and we've seen a lot less worry about inflation recently. There was, however, somewhat of a monkey wrench in that thesis. We have seen just yesterday, the New York Fed survey of households showed that households are projecting 1 year ahead inflation to be 4.7%. That is an increase from 4.2% in February, the first increase in year-ahead inflation expectations since October. So a big part of inflation is what people expect to happen. People expect inflation to fall so they don't demand higher prices, or they don't demand higher wages. They don't demand a big raise. They don't demand to be paid more because they don't see prices rising on everything around them. Inflation expectations also tell people, oh, well, this thing is priced higher. I'm not going to buy it. And I'm not going to pay that higher price. I'd rather just not buy this item or buy a lower price item. That also helps bring inflation down. So inflation expectations for the year ahead rising for the first time since October. Last month in the New York Fed's survey of households, 3-year inflation expectations also picked up. But 5-year inflation expectations decreased a little bit to 2.5%, much closer to the Fed's 2% target. The Fed has to be a little concerned about the results of that survey yesterday because, that is something that has a big effect on inflation expectations, and the Fed's got to manage those. One other note from that Fed survey, Americans said that access to credit was at its toughest level in nearly a decade. That's definitely something to keep your eye on. Small businesses and consumers are having a tough time getting access to credits. Banks are pulling back on lending, pulling back on granting credit. We've seen that in a lot of the data, and that has just been reinforced by this New York Fed survey. BlackRock, PIMCO, and some others are starting to warn more seriously about recession risks, and that ties to this lending and this credit. A lot of folks have kind of run out of money. Those savings that they built up during the pandemic have sort of run dry, and now they're using credit cards, personal loans, things like that. Small businesses are having to draw on credit lines, and we're seeing that access to that is getting a lot harder to come by, and that is generally a good precursor for recession. So definitely keep your eye on that. Check out those BlackRock and those PIMCO reports about recession risks. They say that they expect the Federal Reserve to keep interest rates high, even as inflation starts to kind of come down, even with what we've seen today on CPI, and that could lead to a likely recession. That's what some of those professional asset managers are talking about. Fed speakers over the past couple weeks have really studied this. They've said we are likely to raise rates in May. Keep your eye on that. Fed President Loretta Mester, as well as St. Louis Fed President Bullard, both railed in and came in and said this. We expect to keep rates high. So that may just be for May. That's how the markets are assuming it. They're saying, hey, Fed's going to raise rates in May, then they're going to cut. That's a big part of the market narrative and the increases in stock prices that we've seen lately. We're seeing a kind of theme of the markets versus the Fed. The market's not believing the Fed's going to do what they say they're going to do. Keep your eye on that. That's a big theme moving forward. Listen, here's what comes next. We get the PPI report, the Producer Price Index. That's on Thursday. That's expected to fall to 4.4%. We've seen PPI lead CPI, and so if PPI comes in as expected, that's a good sign, especially given the lower than expected CPI report we got today. A good sign that inflation is moderating, going away. That's more good news. Keep that on your radar. We also get retail sales. The retail sales report is out Friday. It's going to show us what people are buying, what they're not. Bank earnings is out on Friday. Bank earnings are out, I should say. The big boys, Citi, Wells Fargo, JP Morgan Chase, they'll all be reporting on Friday. We're going to learn a lot about the economy from that. And so we will be here on Monday talking about what we learned from the bank earnings reports and everything we got last week. And we'll be looking ahead to next week. I hope you'll join us on Market Takes on Monday. We'll be talking about the NAHB housing market index, as well as housing starts, the Fed's beige book, and U.S. manufacturing and services PPIs. We will be getting into all of that. Listen, that's going to do it for us here on Market Takes. I'm your host, Dion Rabouin, reporter at the Wall Street Journal. Thank you so much for being with us, and we will see you next time.